Testing 1, 2, 3. Testing 1, 2, 3. All right, folks, let's get started. Something I need to mention really quick. I am recording this as we speak. So there will be a significant delay, however, between when I'm speaking and when you actually hear me speaking. Now, you won't notice that, but I do. I'm actually watching my stream as it's broadcasting live, so there's about a 20-second delay from what I can tell. So just bear with me on that. Okay, so firstly, thank you for joining. Again, my name is Mike Patton. I'm a little casual today with the hat, but I'm working from home doing today's boot camp, and partially because I want to be in an environment where I have some other tools available in my home that I want to utilize, for some of the research I usually do at the house. But also there's some other technical reasons why I want to work from home today. So anyway, let's go ahead and get started. So firstly, let's look, if you have any questions or comments, you can go in the chat. You'll see a little chat box at the bottom right where you can add comments. So I'll just put one in there right now just so everyone can see what I'm referring to. Okay, so I just put that in there. And if you have any questions or comments, you can type them there. I will definitely see them, and then we'll go from there. Now, that being said, let's go ahead and get started with today's topic. Okay, I'll have to look to my right periodically, so apologize for that in advance. But today we're going to go over a few topics, and we're basically talking about today what causes stocks to trend, how to find stocks with high demand early enough to optimize our profits, and then we're going to talk about techniques to implement to take advantage of opportunities. Okay, so we're going to do all those things. Now, let me go ahead with our first slide. Let's start with our first topic. What causes stocks to trend? Okay, now this is a question that a lot of people ask. When you're newer to the markets, you probably are wondering, how or why does a stock decide to go up or down? What's the reason behind that? What causes people to want to buy or sell a stock? And there are lots of explanations that are given on the internet for why, but my experience is that most people don't actually talk that much about what causes a trend. They spend more time just talking about what a trend is. So why don't we start off first with defining what a trend is. So what is a trend? A trend is what happens when something persists to repeat a certain pattern over and over again. Okay, so I'm going to jump to here, to our Madison platform, and let me just go over what a trend looks like. Okay, so if I go to a chart and I pull up the SPY, okay, on a chart, and I look at its history, I can see that it's generally gone up. So I'm going to hide some of the tools here so it's easier to recognize what I'm pointing to. So here's the S&P 500, and as you can see, it has generally gone up. Okay, so if a stock generally goes up over time, we call that a trend. Okay, but a trend is only identified after it's been present for some time, right? Trends could also take place in things other than stock charts. There could be a trend of buying or selling before the stock actually starts to move. There could be a trend of investment into some sectors and divestment out of others. So these are all trends too. We could also consider interest rates being raised over and over again. One meeting after another with the Fed. That's a trend, you could say, a trend in interest rates. So the word trend and the way it's applied in trading simply means something that repeats itself. It continues to happen over and over again, where we see some sort of momentum, some sort of tendency for things to persist, right? Now, of course, if momentum of a trend were perfect and never changed, then the stock trend would just keep going forever. But we've never seen that. We've seen trends that persist over long periods of time. In our last boot camp, we discussed what causes trends or markets to appreciate in value over time. We talked about the reality of economic growth causing equities markets to appreciate in value over time. But that also has to be looked at in terms of individual stocks. But because the overall economy is growing doesn't mean that a particular company is doing well. We all know that companies come and go. If we look over the history of the country, we can see that there have been companies that have come and go. I remember when I was younger, they had the retail store Gimbals, right? I remember something called the Five and Dime. I remember all sorts of stores that used to exist no longer do, right? And why don't they exist? How about Netscape Navigator, which used to be a big, it was like the first really popular browser. And that browser basically took over the internet for a while. So we had that. And then after a while, it just went into oblivion. So in short, trends can be created, companies can come and go. But overall, if the economy is growing as new companies come in and the amount of goods and services keeps increasing, that even if some companies don't survive, the overall economy still grows. So when we look at individual stocks, even if the whole market is going up, it doesn't necessarily mean that stock is. So trends within individual stocks may be created for other reasons. Now we're looking at the S&P 500 here, so this is an overall market picture, so our ETF, so therefore different story. Okay. Now, so a trend can be up, trends can also be down. So if we look at, for example, VXX, which is an ETF for the VIX, we can see that this trend has generally, not always, but generally gone down. Sorry, this is not doing what I want. There it is. So generally this goes down, and these big gap ups that you see here on the chart, what are causing them is that there was a reverse split, and then the stock price is raised. I'll go over that in another time, but bottom line is the overall trend is down. I think there's another, I'm trying to remember what it is. It's let me look it up, inverse. Let's see. 3 times bear. Let's see. SH. There's several of these, but you know what? Don't worry about that. Basically, all I was trying to point out is that some stocks trend down over time, some don't, some go up. So it all depends on the circumstances. I do remember one stock that now comes to my mind, Lordstown Motors, RIDE. Okay, this stock has been trending down for a long time, right? So clearly there must be some reason why the stock keeps going down. Now some people would say, well, it's just because the trend is down, so people keep selling it. Well, people can keep selling it. Remember, a company has actual assets and value. They actually have goods and services, so those things have value. Therefore, if the value of the stock goes lower than the actual value of the assets, that gives you an incentive to buy, because if you own shares of the stock, you are part owner of the company. So therefore, those shares are directly legally connected to the actual value of the company, which means that if the company were ever to go bankrupt, the shareholders would be able to split the proceeds of the sale of the company, right? So therefore, if there's any value left, the shareholders would be entitled to whatever value per share comes to them. Point being, this is one of the reasons why being a shareholder is meaningful, because the actual assets you have, the shares of the stock, since they are directly legally connected to the stock, then that means that they have actual value. So if the value of the stock gets lower than the actual value of the assets of the company, as I mentioned before, that is an incentive to want to buy. That doesn't happen very often. It did happen some time ago with the company Ford. It was about 2 years ago. But one thing to keep in mind is also that companies have obligations, like future obligations. So just because right now the assets of Ford might be worth X, it would take some time to sell the company, and if they have forward obligations, like cars they have to build and debts they have to pay, then that has to be factored in too. All right, so now we know what a trend is. Okay, so we've just given a definition. It's just a persistent pattern of things going. I've showed some stronger examples, so therefore we can get a sense of what a trend is. And trends can last for years, they can last for months, they can last for seconds. We have to define what time frame we want to look at, but generally when we think about trends, we're thinking about things that go for at least hours if we're looking intraday. And if we're looking at something for a longer term, we're thinking of things that trend for weeks, months, or years usually. Okay, now that being said, let's move on to our next point. So now we know what a trend is. What are investment funds? The reason I'm bringing up investment funds is because, as we'll see, they are the primary force behind trends. What I mean by that is this: the market is an open to the public domain. In other words, people can trade the markets as they see fit. We can buy and sell shares of stock. These are publicly available, publicly traded assets. That's the whole purpose of the stock market, to allow people to easily exchange ownership of actual companies without having to go through a laborious process of filing documents and getting a lawyer and everything like that, and then negotiating with the company. And this, in the open market, you basically can just buy and sell stocks at will. You can be an owner of a company 1 minute and get rid of your ownership and sell it to someone else the next minute. And of course, if the value appreciates during that time, then of course you make money. So stock ownership is meant to be an easy exchange of value. And as a result, what that means to us, the traders, is that we can easily take advantage of the values of companies. Now, investment funds are the dominant forces in the market. When you think about an investment fund, you have to think about big companies like Fidelity, for example, or Vanguard, for example. These are retirement-focused companies where people put their money to invest for retirement. And the logic is the markets appreciate over time, so therefore if you have exposure to the markets over time in a fairly representative selection of stocks that represent the market as a whole, as long as the fees are not too high for the fund that you're in, you should generally do well if the market does well. That's a pretty simple concept. So that brings me to my first question. You have two types of funds. You have passive funds and you have an active fund. So passive funds basically are things that are not very actively managed, and basically what they're designed to do is they select a grouping of stocks based upon some sort of exposure. So for example, someone could say, I want exposure to foreign Chinese stocks. Okay, so someone could create a fund that invests into Chinese stocks, and they're of course going to choose the most stable, the most established Chinese companies that represent the general Chinese stock market, and then they invest into those. Or someone would say, I want exposure to the US markets. They could easily buy a Dow fund, where they hold stocks in the Dow, or they could buy an S&P fund, etc. So passive funds, the idea is that they buy shares that are representative of something, usually a sector or an entire index or entire country, or sometimes it could be even a continent. It could say like Asian investments or North American investments or African investments, etc. And then they just park the money and leave it alone. And basically, if the value of those assets goes up over time, you make money. If they don't, you don't. So that's what a passive fund is. It's not designed to be actively managed. One of the greatest examples we were just looking at is the SPY, the SPY index, or SPY ETF, which is based upon the S&P 500 index. This is a passively managed fund. It is not designed where the managers are deciding which stocks in the S&P 500 are going to be good or bad. All they do is they accumulate shares of the S&P 500 stocks in the proportions that the S&P 500 dictates. So if one stock represents a larger proportion of the S&P 500 than another, then they will have larger holdings of that stock than the others. So in short, when you do investment into these sort of funds, you're not banking on the skill of the fund manager. You're not looking for the fund manager to be a superstar who's going to deliver great returns. You're just getting into it because you want exposure to the S&P 500, and the fund manager has created a fund that allows you to get access to that. So the job of this type of fund manager who manages the SPY, their job is just to make sure that the assets are in order, meaning that you have the right grouping of shares in the right proportions. Okay. Active funds, in comparison, would be the type of funds that are managed by people that we all hear about. Remember, in our last session, we talked about people like Bill Ackman. We talked about people like George Soros, Warren Buffett. These are all active investors. They manage active funds, meaning that they actively select what they want to invest in. This is what made Warren Buffett famous, that he was better at selecting stocks than obviously the people who created the S&P 500 are, and manage the S&P 500. In other words, the people who created the S&P 500 and who manage it, their selection process has underperformed the selection process used by Warren Buffett, or the selection process used by George Soros, or the selection process used by Bill Ackman, etc. In other words, all of these investors and fund managers who have beaten the S&P's return have done so by being better at selecting stocks than the S&P 500's methodology dictates. And remember, as we mentioned in the last boot camp, it's just a selection process. Okay, there's nothing dictating why one index makes any more sense than another. This is something that's very important to understand, that indexes are chosen by the people who create them. We create them. In other words, Kathy Woods created ARK Fund by selecting specific technology stocks that she wanted in her portfolio, right? And she does actively manage it, so she's more of an active fund manager. Whereas if she had just selected a grouping of technology stocks and left it alone, that'd be more passive. In other words, there are technology sector ETFs. Let me show you one of them. Okay, it's called XLK. Oops, sorry, typing in the wrong place here. XLK. And XLK is a technologies ETF. Sorry, 1 second here. And actually, let me type it in the chat too. So XLK, sorry, XLK, oh, come on. XLK was the example. I'll just leave it on the screen. Sorry, oops, I guess I didn't type it in. XLK, there you go. So XLK is an example of a technologies ETF. What that means is someone has chosen to create a fund based upon technology stocks, and they have chosen which stocks they want to put in there. They've chosen what proportions those stocks should be in. Now notice what I just said. The ETF creator chose which stocks to be in the technology fund. There's many technology stocks, but they didn't choose all of them. They chose certain ones, and they proportion the amount of holdings based upon what they believe are the better technology stocks. In other words, they have holdings in stocks like Microsoft, for example. Microsoft, of course, being a very clear and present and strong contender in the technology sector. Microsoft has better performance than a lot of other stocks, and as a result, there's a tendency for technology funds to have strong representation of Microsoft in their holdings, whereas some other stocks that are not so well known or not so successful might be smaller holdings. So in short, the funds are choosing what they want to be in their funds, and then once they've chosen them, the ETF just reflects the value of those stocks. And of course, if one of the technology stocks has to be ejected from the ETF because maybe it's going bankrupt, or maybe it no longer meets the minimum requirements set by, again, chosen by the creators, then the fund will change where they get rid of something and replace it with something else. And of course, that will affect the overall future performance. So in short, even though passive funds are not being actively managed, they still have a selection process. Someone is still choosing which stocks to put into these funds. The only way you could create a passive fund that would have you still have to choose to do this, but the only way you could create a fund, in my opinion, that was the least managed possible would be literally to buy shares of every stock in the entire market. Just in other words, you would buy them. How you decide to do that, again, that's up to their discretion. They could say, hey, we want to buy 1%, or let's say they want to buy 0.1% of every stock that exists, every single stock that's listed publicly. We want to buy 0.1%. And if it gets delisted, then oh well, we'll just replace it when another stock comes in, or maybe no other stocks replace it. Who knows? But that would be a full market exposure fund. You would have shares of every single stock. Now, I do think some funds like that might exist. I have to check on that. But the reason why I don't think that's that important is that even if you did that, what would be the benefit to the investor, right? So with funds, they have to think about what's the benefit to the person buying the fund. Are they really going to care about having every single stock, or are they looking to generally have exposure to a set of stocks that make some sense to them? So ETFs that become popular are the ones, and funds, I should say, that become popular, passive funds, are the ones that actually best address the needs of investors. Now, here's the interesting part of this. So notice that the fund is created to give people exposure to a certain asset class, a certain sector, right? So who is investing into the fund itself? In other words, the fund is created, but why is there money in that fund? Why does the SPY have so much money? Let's actually look at the numbers here. So I'm going to go to ETFs first. I was going to go to mutual funds first, but let me look at ETFs. So here are the largest ETFs, the top 100 ETFs by assets. And those, they're not saying the best performing ETFs, the ones with the best returns. They're just saying, here are the biggest ETFs. Here they are. So first place, as I mentioned, we have the SPDR, the SPY. The SPDR ETF SPY has, as of the date of publication of this, which I believe was recent, $344.032 billion of assets under management. Now, what does that mean to you and me? What that means to you and me is that different groups of investment entities, whether it's individuals or institutions, they have put money into this ETF. They have purchased shares. And as more money comes into the ETF, as more demand to buy shares, the ETF may have to grow its portfolio. In other words, it may have to add more shares. And the only way it can do that is it has to actually accumulate more stock. It has to go out into the open market and buy all the stocks that are required to be in the fund and get them in the right proportions. So the SPDR ETF is a fund that was created specifically for the purpose of allowing people to exploit or get exposure to the S&P 500 in a convenient fashion. So what makes it convenient? Well, you have two types of index or passive funds generally. Those that are more or less mutual funds types, which would be they're places where you put the money in, but you can't easily get it back out. You can get it back out, but it's not that easy. In other words, the fund is not going to be listed on an exchange where you simply can buy and sell shares of it just like that. You can't do that for mutual funds. When you want to buy or get into or get out of a mutual fund, you can buy and then sell, but you have to you're basically rolling out of an investment vehicle into another investment vehicle. So it's like switching IRAs. It's maybe a little faster than that, but it's like changing from one IRA custodian to another, or one 401k to another. The point is, when you get out of a mutual fund, it's not like a quick, easy process, because you're basically signing away the right to have easy access to your money. Once you get into a mutual fund, you're giving up the management to the manager. And it could be a passive mutual fund in a sense where they're just, buying shares of S&P 500 stocks and holding them, and that's the mutual fund. And as more money comes into the mutual fund, as people make contributions, into their retirement portfolio, the fund has to then go into the open markets and buy up shares of whatever they're supposed to. So if it's the S&P 500, as money is put into their coffers to be put into the markets, the mutual fund has to go about into the open market and buy up shares. And notice what's happening here. people are saving for retirement, right? They're putting their money away. They're giving it into a fund, Vanguard, let's say, that's going to park the money into the markets. So when they give it to Vanguard, Vanguard then has to go and buy something to that represents the S&P. Now, I don't know what the rules for Vanguard's particular funds are, but some funds should be able to. I don't see any legal reason why they can't. They should be able to buy ETFs. So think about it like this. Vanguard could have an index fund that tracks the S&P 500. And in order to make it easier for them to accumulate new shares as more money comes in to their coffers, in other words, as more client money comes in that needs to be put into the markets, they could just say, well, you know what? We can buy shares of the individual stocks, and we can also buy SPY, right? We can actually buy the ETF itself as one way to get exposure, because as long as the ETF does what it's supposed to do, which is it tracks the S&P 500 by owning in the right proportions the shares that are in the S&P 500, the stocks that are in it, then that would be one way for them to gain exposure without them having to go through the process of individually buying stocks. So that means that one fund can be invested into another fund. And this is not abnormal. This is very, very normal. You have what are called funds of funds as well. These are actual funds that are created where they just pull money from investors and they say, okay, we're going to select which other funds. We're going to get into hedge fund X and hedge fund Y. We're going to put money into each one in the proportions we think are right to balance the portfolio the way we think it should be. In other words, you can have a fund that's built with other funds. So a way of thinking about it is this. If you created a fund and you called it the Alpha Fund, and you said, my Alpha Fund, I'm going to create it and we're going to have a maximum of $100 million under management. That will be our cap. And we're going to take that money and we're going to invest it into ETFs only. We're going to buy ETFs, which are funds themselves. And we're going to choose which ETFs to be in based upon our algorithm, our market model that we've created that quantitatively analyzes the sectors and figures out what to invest into, right? You could do that. In fact, a lot of funds do that already. So in short, this is why I say that the funds are the driving force, because not only are funds created that make it easy for investors to jump in and out of entire sectors or entire indexes, you have that, but then you also have funds that use those funds to actually be managed under them, under their umbrella, and they're choosing which funds to invest in. So you could do that passively, which would be you just choose, I want the SPY, the QQQ, and the DIA, and that's it. You could do that. You can create a fund that basically only invests into the SPDR ETF, the NASDAQ ETF, and the Dow Jones. I don't know if it's even on here. It should be. The DIA, there it is. The DIA, you can invest in those three, and that will mean you have exposure to the S&P, the NASDAQ, and the Dow. And you can create a fund that says, oh, we're just going to hold assets, and that's it. We're not going to choose to increase our S&P holdings and decrease our Dow holdings. We're just going to keep them in a certain proportion for life. Okay, that would be a passive fund. An active fund might say, we're going to do investments in to the S&P, the SPY ETF, we're going to do the Dow Jones, we're going to do the NASDAQ ETF, but we're going to choose which one we want to emphasize. So maybe sometimes we put more money into the QQQ and less money into the Dow. And then other times we do the opposite, or some other combination. So you could create a fund like that, or you can create a fund where you don't want to get into ETFs at all. You might just want to focus only on individual stocks. So it's totally up to the industry and up to the fund managers and the people who create these funds what they want to invest into and how they want to proportion it. So this is literally the driving force behind the markets. It is not individual investors sitting at home on their computers like us deciding to buy or sell, nor is it proprietary traders at companies like Great Point Capital or et cetera, where we're day trading all day and trying to squeeze money out of the markets. No, the market is dominated by the big players. And let's look at the numbers here, okay? So let's compare some numbers. So here's the SPDR ETF. As I mentioned, it's $344.032 billion, which is a lot. But I want you to look at something else. Look at the biggest mutual funds. Okay? Top 5 biggest mutual funds. I want you to look at these numbers. Vanguard Total Stock Market Index Fund Admiral shares, $1.3 trillion. Vanguard 500 Index Fund, 808.8 billion. Vanguard Total International Stock Index, 385.5 billion. So notice that the top 3 Vanguard funds alone have more money each than the entire SPY ETF, which is the biggest ETF in the world. So the biggest ETF in the world, passive ETF created to allow people to invest their funds into the S&P 500, has less money in it than the Vanguard Total Stock Market Index Fund, which, by the way, is basically following the general market as well. They're just putting money into it on their own, right? But here's the Vanguard 500 Index Fund, which, of course, as you probably guessed, the 500 means that it's probably S&P focused. It has more money under management than the SPY. This is proving the point I was making, that what's different about these mutual funds and these type of investment vehicles is that the money's coming into Vanguard, the company. The Vanguard set up relationships with businesses, companies, where their employees or contributions are going into Vanguard as the manager. And then Vanguard has to take the money and put it into the markets, and they have to choose how to do it. So the ETFs are basically created as a convenient way for fund managers to get exposure to different sectors, different regions, etc. And then the fund managers choose which ones they want to invest in. So the biggest investors into ETFs, and ETFs are funds, are actually bigger funds or even sometimes smaller funds. But either way, it's fund managers who usually are managing retirement portfolios who are the biggest investors into these funds, these ETFs. One of the clients that we've had, she mentioned to me that she had an account with a major investment firm, UBS. And what she said to me was that her person at UBS actually put her into ARK Fund. ARK Fund is an ETF, again, created by Kathy Woods. And the logic was they wanted to give her exposure to the tech sector, and that was one of the better performing ETFs, so they put her in there. So there you go. You have a bigger firm, UBS, taking client money, and they have a fund that UBS has that her money is part of, and then they're buying into ETFs. So, amongst other things. So as you can see, you can have lots of influence on the ETFs themselves due to the activities of institutions, and institutions can use ETFs to create bigger portfolios for themselves. Now we look here at the biggest, at the global assets in the passive. This is looking at global passive assets hit 15 trillion as ETF boom picks up. What they're saying basically is that more money is pouring into ETFs, and therefore more ETFs are being created to accommodate that money. So as portfolio managers look for more ways to diversify their investments or get exposure to more unique sectors or technologies or whatever, they may pour their money into particular types of ETFs. And then as ETF creators get more clever and they figure out how to better accommodate the market, they come up with more products that can be utilized. So the investment managers are the ones who are actually, they're basically the ones who drive the demand for ETF products. And they create the environment where ETF creators, who are funds themselves, can thrive. So it says here that we have $7.7 trillion under management for ETFs, and we have $7.76 trillion for index mutual funds, like the Vanguard stuff that we were just looking at, right? So what this is basically saying is that Vanguard obviously owns a large proportion of this, because we looked at their numbers. They have over $1 trillion in assets. So that means that Vanguard by itself represents a huge chunk of that number, right? And that means that also probably a lot of their money is actually in ETFs as well, you know. So this is the driving force. Now, when most people think about trading, we think about, of course, trends and things like that, and we may think about, buying into a stock, getting in on a trend, and watching the trend go, or short selling a stock and it's going down, or watching a trend go. So the question would be, so that type of trading is not the sort of stuff that these guys are primarily doing that we were just looking at. The mutual funds, the index funds, etc. They're not generally, in other words, not just generally, they're just not trading as a pattern. They're not trading based upon the existence of trends that have been going for a while, because they're the ones who are actually creating the trends in the first place. It's their activity of buying and selling that actually makes the market move, because they're trading in such large size. So therefore, if they're not doing that, then that means that the majority of what we're seeing in the market movement has nothing to do with people looking at chart patterns and saying, hey, this chart's going up, so I'm going to keep buying. But there are people who do trade that way. And of course, when we're doing our individual trading, that's what we're basically doing. We're trying to spot trends early, get into them, and ride the trend, right? That's what we're at every time. That's what we're really, really doing. If we're not doing that, if we're just buying stocks for fundamental reasons and we're holding them long term, we're looking at the future potential value, then we have to be longer term view, because fundamentals, although they drive prices of stocks, it's not until investors, institutional investors, actually start buying or selling that the stock actually starts to trend. So we can see what precedes it, the fundamental changes, but we have to wait until the institutions actually take action for us to be able to exploit any of that. So if I'm a longer term investor, fundamentally driven, that's it. I don't have to worry about whether the stock's going down. In fact, if it's going down, better for me to buy, because I get it at a lower price and I see the future value being much higher, so that's fine with me. And as a trader, I have to time my entries where the market's starting to go the way that I want. We'll get into that a little later. So now we want to talk about hedge funds. Most people talk about hedge funds because we think of them as like the biggest, baddest people in the room. And in some sense they are, but they're not actually the biggest out there. And let me show you what I mean. So if I go to, I'm going to show you a listing of hedge funds. I just have to look over to my right for a second, so just bear with me as I pull up these documents. So let's look at hedge funds. Who are the biggest hedge funds? Who are they? All right. So just making sure my feed is still going. Okay. So we look at the list of hedge funds, we can see who are the biggest, right? So here it says Bridgewater Associates is the biggest. Now who is that? Well, that's Ray Dalio. Ray Dalio is a very famous investor. He's a hedge fund manager. He's an active trader, an active manager. So what that means is he looks at trends, potential trends in the markets, and he makes decisions based upon what he thinks will be the future of basically, anything. It could be where he thinks stocks in China are going to go. It could be where he thinks an individual company's value is going to go. But generally, Ray Dalio focuses on the big macro picture, which means that he's less likely to be involved in individual companies, more likely to be in groupings of companies, groupings of exposure to overall markets, right? So he's not likely to be the guy that's going to go into a company and say, hey, I'm going to turn your business upside down. Here's what you need to do. He's what we call global macro. He's the same as George Soros. George Soros is global macro. He looks at big picture stuff, currencies. He looks at commodities. He looks at entire equity indexes, like what's going to happen to the Chinese stock market, what's going to happen to the Chinese real estate market. So notice he's not focusing on an individual company. Whereas someone like a Bill Ackman, he's going to focus on individual companies, just like Carl Icahn. They're going to go into an individual company. They're going to turn it around Warren Buffett also focuses on individual companies. He's not global macro. He's not looking at what's going to be the trend of the currencies markets. They may use that as part of their decision making process, but generally they're going to focus on, overwhelmingly, they're going to focus on investing into individual companies, significant stakes in them, and basically steering helping the company steer in the right direction. Okay, so that's what, so Bridgewater Associates is focused on global macro, whereas Renaissance Technologies is actually focused on trend analysis, short-term trend analysis. So Renaissance could be considered, depending on how you look at it, it could be considered well, you could call it a trend following company, but it's very sophisticated. It's not like they're just looking at a chart and saying, oh, it's going up, so we're going to buy, or oh, it's going down, we're going to sell. Not like that at all. What they're doing is they're using a very robust, very complex, super complex, incredibly complex. No one knows exactly what they do, but the bits and pieces that we can know, we know that what they're doing is exceptionally complex. And basically they're using a team of top tier PhD Nobel Prize winning types to manage their fund. And this is literally true. They're just engineers and scientists and data analysts, etc. And they're top tier always, mathematicians. And what they do is they use all of their skill and genius to create models of stock behavior. They actually figure out where the market's likely to go over short periods of time. They're not looking at very long time frames. They've emphasized that plenty of times, that they don't stay in very long. So they may be in for hours or days, maybe even possibly weeks, but not longer than that as far as what they said. So basically these two funds, Bridgewater and Renaissance, are totally different. It's in terms of their approach. Bridgewater is really looking at where the overall markets are going to go, whereas Renaissance is looking at the trends that will occur in individual equities based upon their research, based upon their mathematical models. So they're different types. They're all different types, and some of these I recognize, not everyone. BlackRock is more focused upon creating funds that people invest into. They're a big ETF creator, for example. So you've got a large variety, but if you look at the numbers, so these are millions. So what that means is Bridgewater has $105.7 billion under management. If I'm doing my math correctly in my head, I said millions. This would be 76.8 billion. This would be 58 billion. So these are large amounts. Now, I want you to think about that for a second, because this represents a large amount of different types of hedge funds, right? They all have their different approaches. If I go to look at the hedge fund database from Barclay Hedge, which is the premier place to get this information, these are the numbers that we see. So currently, hedge funds have $4.872 trillion under management. Okay, in the entire hedge fund industry. That's the entire amount. So $4.872 trillion. Now notice that that's not as big as what we saw for those passive funds, those passive ETFs and passive mutual funds. They had much more money. They had, what was it, $15 trillion or something like that. About $15 trillion under management. Whereas the hedge fund industry as a whole has less than $5 trillion. So it's one-third the size, it's less than one-third the size of the passive funds. Now, a lot of people think that the hedge funds are the biggest players of them all, but that's not true. It's actually the passive funds. It's Vanguard, it's Fidelity, companies like that. I mean, Fidelity by itself actually has nearly as much money, or Fidelity and Vanguard together have about as much money under management as the entire hedge fund industry combined. And that includes all these big name hedge funds, Bridgewater, Renaissance. So the question would be, why aren't these much bigger? Why don't we have vastly more funds in these hedge funds? Why wouldn't we, is the question. And the reason why is this. Because these are actively managed funds, or at least most of them are very actively managed, because of that, And BlackRock actually is active. I mean, BlackRock has ETFs, if I remember correctly, but they do a lot of other stuff too. So let's just be clear: they're not they're very active in what they do in the market. So I wouldn't consider them passive funds. They're definitely active. But the point is, the reason why active funds are not as big, and hedge funds are always, always, always active. There's no such thing as a passive hedge fund. And if anyone ever said there was, I would say that doesn't seem to fit the definition. A hedge fund is an actively managed fund. At least that's what they've been for the vast majority of their history. So when we look at hedge funds, these are funds where people are making decisions. Traders are deciding what they want to invest into, what direction they want to go. So when we think about that, the reason why that is not the majority of the money out there is very simple. Because if it were, where would they find their edge? Where would they find their advantage? In other words, if everyone's trading actively, they're moving into stocks to expect the trend to go this way or that way. But all of them are doing the same. All of them are looking for a trend to go one way or the other, and they're basically just going to convolute things and make it difficult to make any money. So in short, the passive funds are the ones that are the dominant force. That's where the majority of the money moving in and out is. And again, I mentioned that passive funds have reasons they have to buy or sell. So they actually create trends. Active investing funds do create trends as well. So I'm not in any way implying that these actively traded funds don't influence the markets. They absolutely do. They absolutely do help move trends up and down. But my point is, they can't get it so big, because once they get too big, they're actually the main influence of the market. And if they're the main influence of the market, then they can't really do much, because they're essentially trading against themselves at that point. So you need to have a large body of dedicated money that's coming into the markets to buy or sell for reasons due to retirement, investment, etc. And then these sort of hedge funds, they try to take advantage of it. But in this group, there's different strategies. Like I said, global macro is a very different strategy than what's being used at Renaissance. And that brings me to my next point. This company here is a hedge fund, okay, and they're talking about what's called trend following. Graham Capital, I don't know them personally, but what they're discussing is trend following. What trend following is basically what I mentioned. Is you're looking for a trend, you're buying when you think things are going to go up or continue to go up, and you're selling when you think things are going to go down or continue to go down. So you're following the trend, right? That's what we do. Okay, that's what you're doing, that's what I'm doing. In the vast majority of the time when we're looking at stocks, we're literally looking for potential trends that could continue. We see the beginning of a trend and we get in. And we hope that's the beginning. Obviously it could possibly be the end, but we want to get into circumstances which typically lead to more follow through, right? So we are trend followers. And this company is defining what trend following is saying trend following strategies use a systematic approach. That means that they use a rules-based approach. It's not based on my beliefs about the markets or my conversations with different people to figure out who's a better manager and who can manage the company better. It's not that. The systematic approach they're saying is it's looking at numbers and data. It's looking at pattern recognition. That's what trend following is about. And it says whereby algorithmic models, and then the term models means that they've created some sort of mathematical, statistical, etc. model of the market that they're using to influence or to determine what to buy and what to sell, how much to buy, how much to sell, etc. Seeks to identify price trends in the markets with the expectation that upward trending markets may continue to rally and downward trending markets may continue to decline. Now, I emphasize this is a PDF from an actual hedge fund. So this is a very useful document because it allows us to get a glimpse into the way these guys think. So they're describing their strategy, and they're saying how trends are identified, market price history, market volatility, risk management. So as I say, classic trend following is trend looks like it's going up, you buy, trend looks like it's going down, you sell. That's it, right? So Everyone knows this. We look at moving averages, things like that, RSI. People come up with all sorts of ways to do this sort of thing, but the real professionals, they do it in a much more advanced fashion. So Renaissance Technologies, like I said, these guys fit that definition very squarely. That's what they do. That's really what they do. So with that in mind, Renaissance Technologies is a extremely sophisticated and extraordinarily successful version of what Graham Capital is attempting to do. In other words, Graham Capital is not nearly as is not successful to the level of Renaissance Technologies, which is why they don't have as much money. Nowhere close. So I'm not going to get into all the details, but I wanted to go over one thing they specifically say in here that I thought was interesting. And okay, there are two things actually. One, first of all, let me see if I can find the. I was looking for a number here. There it is. Nearly $300 billion in assets under management. They're saying for the entire trend following industry, $300 billion. Okay. Now, Renaissance Technologies has $58 billion, which means that they represent a large chunk of what would be considered trend following, assuming they are classified as such, which they should be. So in short, Renaissance Technologies represents a large proportion of that number, which means that there are not that many trend following strategies out there. There may have been a lot more in the past, but not much as many anymore. Part of the reason for this, the markets became much more difficult to use trend following methodologies on. So Renaissance is so sophisticated and their patterns that they've identified are so obscure, and they require, very sophisticated mathematical modeling and computer technology to even be able to detect what they're detecting, but it works. They're consistently the best performing hedge fund percentage wise in the world, for a long time. So in short, simple trend following methodology is never going to give us the type of returns that Renaissance can get, because we would need much more sophistication. That's the reason why I advocate a hybrid approach where you're using some of the technicals and statistical and mathematical modeling, as far as analyzing trends, but we also need to look at fundamentals. So essentially what we're doing is we're combining some of what Bridgewater Associates would do, or Warren Buffett, or some investor who's looking at the actual fundamentals of a company and analyzing that. And we're also looking for pattern recognition, looking for signatures that a trend is likely to commence and continue, which is more along the lines of what Renaissance would do. So by staying in that quantimental space, is what it's called, we're able to be more effective as individual investors at a smaller scale without the ability to utilize the level of sophistication that major firms could. And we're also, of course, letting them create the movements. We're deliberately trying to follow the trend makers, is the way I like to say it. We're looking at the people who create the trends. We're trying to capitalize on the movements they create by carefully analyzing their activities. And when we look down here, I want to point out one last thing. This is their graph. It says, like all asset classes, trend following has periods of strong, challenging, and flat performance. Even in the recent 2015 to 2018 drawdown in trend following, the strategy has maintained a strong return profile over the long term. This is the entire industry they're looking at. So what they're saying is the trend following approach has generated 122% from 2000 until basically 2021. The global equities have returned 140%. What that means is the global equities markets have done better overall return than the actual trend following, and et cetera. So hedge funds, I'm not sure why they're separating that off that way, but whatever the case may be, all of these have returned decent, right? Bonds have returned 100%, equities 140%. So what this is actually pointing out as well is that the general market trend has still been up. So therefore, I think this actually goes only to 2020, excuse me. But the general market trend has been up. So this does not include the coronavirus sell-off, which would definitely change these numbers significantly. But whatever the case may be, in the presence of a standard typical market environment, which was what we saw from 2000 to 2020 in general, we have some pretty strong volatility in equities. You know, you can see the black line goes sharply down, then it goes up, then it goes sharply down, then it goes up, right? That's due to the ebbs and flows of the equities markets. Bonds were more consistent for obvious reasons. We have a lot of government buying of bonds that keeps the market fairly stable. But when we look at on this graphic, when we look at trend following, the blue line, what they're saying is that the volatility in the returns have been less dramatic, meaning that because they can go long and short, they're able to better weather the bigger volatility in the market, which is basically true, right? In fact, I mean, the markets as they are, if we only look at them for the very long-term view, it's not that difficult, at least the way the markets typically trade, to predict a longer-term downturn and a longer-term upswing. I mean, it's not as hard as some people say it is. So if you manage a portfolio effectively, you could exit when things are looking bad. But it's good to know the precursors, the things that would lead to that change, the fundamentals. And that's what we're going to get into next, which is how are trends created. And just to make sure I summarize the point I was just making, if we can get a similar return with less volatility, that's better, because that means that if I'm in a trend following approach at any given time, I'm more likely to be able to cash out my holdings at a profit than I would if I'm in just the equities more passively. And this is proof, absolute proof, going back to our previous lesson when people say you can't beat the market. Maybe you can't beat it, well, you can. Obviously, many people have, many fund managers have. The average performance of trend followers is not beating the market. The average of all trend following systems is not beating the market in terms of overall returns, but it is absolutely trouncing the market when it comes to the actual deviation, the actual volatility in the performance. And again, that's a big deal, because if you're going into retirement, you don't want to have to be in the middle of a market downturn that lasts for a long time. So in other words, you were about to retire in 2000 and you got to literally wait until 2006 before your money comes back to where it was then. Whereas if you're on a trend following approach and you've got a good averaged out approach that's doing as well as the average of all trend following approaches, you wouldn't have to wait nearly as long. You may only have to wait a year and a half before you can get out and still have the same amount of money that you had at the peak. So that's all it's saying. Basically that you're getting a more stable performance, but we'll see. Depends on the company or and the strategy. So that brings me to the next part. How are trends created? What actually makes markets trend? So I'm going to use some examples from actual stocks for this. Okay, and first let me go back to my slide. So actually I'm still in the same section. So let's finish up here. So what actually causes trends? So Netflix and FLX, stock that I'm sure everyone listening is familiar with. Netflix, as you can see, mostly was going up for a long time. This is a stock that was definitely doing well for a long time. Nice trend up. So if I were to draw some lines on here, oops, sorry. Generally the stock was going up, and then all of a sudden recently we have a very clear demise, and then we have a noticeable recovery. Oops, did it again. There we go. Keep doing that. Sorry. Oh, come on. There we go. Okay, so now we're recovering, right? So what caused this to happen? Why do we suddenly go down? Well, the reason why we went down was because previously Netflix was projecting into the future what was going to happen to his company, and they basically were projecting a certain level of user growth. And of course, the more users you have, the more money you make. Now, the financial markets are not designed to trade only the value of things now. They basically are designed to anticipate future performance, future outcomes, and people will basically trade the stock at some fraction of what the future value they think it's going to be. So in other words, if the stock right now is at $100 and they think that in the future it's going to be worth $500, then you may be willing to buy it up to about $200 in value or $300 in value before that time, like in the near term. So if you think the stock's going to be worth $500 in 10 years, then over a 3-year period, you might be willing to keep buying all the way until it's at, let's say, $300 a share. Maybe you say, okay, well, that's as high as I want to buy because I think it's going to be worth $500 a share, but maybe I'm wrong, right? So people will buy ahead of time, anticipating future earnings, anticipating future growth. But once Netflix sent out a warning somewhere in this period here, I'm just going to circle, I forgot the exact date, but somewhere in the period here, actually I can't circle it, but somewhere in the period here, Netflix said basically this: well, our user growth is not likely to be as much as we anticipated, so we're warning you guys. And that's when it really started to decline, as people said, well, if the company's warning us that the user growth is not going to be likely to be as expected, that basically means at the time that announcement was made, the user growth is not on track. It's well behind. It has to be far behind for them to even make such an announcement. So a lot of times companies warn investors when a large potential move is about to occur. And the reason they do that is because they're trying not to piss off the people who invest in their company. They're trying to give them a heads up that, hey guys, this is not going to be as good as we think. So in short, Netflix took a nosedive as a result of that. And then when the earnings actually came out, they were even worse than people were anticipating. Now, down here, Netflix did beat its EPS, but it was their user growth that was the problem. And a lot of times people don't understand why that's such a big deal. How could they beat on earnings per share by a wide margin? They were expected to get 82 cents. They made $1.33. So why wouldn't that move the stock up? Because again, what was anticipated is that more users would come in, so these earnings numbers would keep getting bigger over time. They would keep making even more money over time. So the fact that they made a profit that's better than expected is good, but it didn't mitigate the fact that there's less future revenue expected for the company than was previously expected. So therefore, the price needed to be adjusted downwards to reflect the new reality. So basically, Netflix was projecting about 8 million users that would be added, if I remember the number correctly, and they only got about 2 million. So it's 25% of what was expected. If you look at the stock, it went from $700 down to under 200. And if you do the math in your head, you can almost tell what happened there. They almost exactly cut the price by about 75% from where it was then. And why would they do that? Because again, they were looking at the future growth. And if the user growth is only going to be 25% or 30% of what was anticipated before, then that means that the stock price is that approximately that order of magnitude too high. So therefore it had to adjust lower. Now that's not exactly how they would calculate, just to be clear. I'm oversimplifying it for a reason. I don't want to confuse everybody. And also there's a lot of factors that these guys look at that I'm not even aware of. But the point is, whenever you have a dramatic shift in the expected user growth or expected growth rate of a company, then naturally the market has to adjust to reflect the new reality. And basically they're just saying, well, maybe in the future, Netflix will be worth $700 a share again. But as of right now, based on the current growth projections, it will be worth a lot less now, right? So why would I, and another point is this: if you're buying it at 700, that means that you're expecting it's going to be worth a lot more than 700 later. So if now you think that 700 is about what it's going to be worth 5 years from now, or 3 years from now, or even a year from now, and you're already at $700 on your investment, you sell it, because why would you want to keep it if you think that that's about as high as the value is going to get in the near term? You can always come back to it a few years later and buy back in when you think that new growth is likely to occur, but why hold it? So in short, Netflix came down because of changes in the fundamentals, changes in the picture. Another two examples, and I'll show you what actually happens. So when people make the decision that things have changed, either positive or negative, the funds take action, the active funds. So notice I said the active funds. If a fund is passively invested into Netflix as part of their technology portfolio or something like that, well, they don't have any reason to sell, because that's not the purpose of their fund. The fund is not there to choose whether it wants to be in Netflix or not. This is a very important thing, because if ETFs are actively managed, when you invest into an ETF, it makes things a little harder, because, in other words, like if you're a fund manager, an active fund manager, and you invest into another active fund, you have to now focus on the performance of that fund. You have to look at what the manager is doing. Now, it's not that people don't do that. Funds of funds do that. A fund of funds invests into other managers who are actively managing, and they make them part of their portfolio of managers, essentially. This manager does commodities trading. This manager does bonds trading. This manager does currencies trading. This manager does equities trading. This one does options trading. And they just basically look at the performance of the managers. They have their own model of how to do that. They probably have their own model of what they think is going to happen to each different market. So maybe they have an opinion on currencies, they have an opinion on options, and they just choose the manager they think is going to be best suited for the environment they expect. Who knows? But the point is, if you're managing active managers, you have a lot more to look at. When you're managing, when you have a passive fund under your belt, you already know what it holds. You already know what the value of its stocks are. So you know what's going to happen if Netflix goes down, how much it's going to affect your holdings in a particular passive ETF. So it's a lot easier to manage, because you already know nothing's going to change except the value of the position based on what the stock does. So in short, fundamentals drive prices, and managers, who are passively running, who have passive funds that own Netflix, are not going to get rid of it. They're just going to hold it. So the people who are actually selling this are not the passive managers. They're the active traders. They're the active investors who are now dispersing their shares because they don't see the future value, right? So whenever this happens, is not the passive ETF managers who are doing this. It's always the active traders, and they're doing it because of some reason, and it's always going to be driven by fundamentals. Because if it's driven by technicals, what was the technical reason why this stock should go down? I mean, is there anything much different about this top than that top, or that top, or that top? I mean, does this one here not look pretty much the same as that one there? They look about the same. So there was no reason for this downtrend to suddenly occur unless there was something else driving the price besides what's on the chart. So again, this is the reason why I emphasize that anyone who tells you you can just look at a chart and there was something that would have occurred up here, something that they saw up there, some obscure pattern, and just said, oh, they're about to sell. And everyone can do this in hindsight. They can say, oh, look, it was a double top and that's why it sold. Okay, well, here's a double top here, there's a double top there, there's a double top there, there's a double top there, there's a triple top there. So what? What does that have to do with anything? It didn't go down because of a double top. A double top may have happened to occur, but it's not the reason why it went down. It's important for us to separate this in our minds. We don't want to start thinking that every time something goes down or up sharply, there must be some pattern that must have been there. There may be no pattern that precedes it because the information wasn't known until it was known. Until they told everyone what was happening, no one would know. Now, I'm sure there were some changes in volume and activity, etc. But again, if you know what the reasons are, if you know the fundamentals, then when it starts to decline, you know why, right? And as a rule of thumb, one last thing on this topic, as a rule of thumb, large scale investors don't go out, they go out of their way to mask what they're doing. They go out of their way to make it less obvious what they're doing. They don't try to broadcast to the world, hey, I'm panicking right now, I need to sell. They don't do that. They try to do everything as quietly and with as little disruption to the market as they can. So therefore, anyone who thinks that they're going to recognize some easy to recognize pattern on the chart that's so obvious that you can basically teach someone that by looking at a bunch of charts over time. No, Renaissance Technologies doesn't do that. They base their decisions on very obscure, highly difficult to detect, even using computers, by the way, sophisticated, ultra sophisticated computers, and people to create these mathematical models and economic models, and hundreds of scientists looking at that. That's what it takes for them to do what they do. And so that means that if we thought that we could just look at a chart and see what they're seeing, not a chance. No way. But we can still see that, yes, things look like they're on the decline, and I could check if there's anything significant that's changed. And in this case, we would have been able to know the news. It was all over the news. So therefore, that was easy to find out. So once these people decided to trade, we can somewhat detect what they're doing. I'm going to look at Enphase, which is a stock that I really like. I do think the stock has good upside potential. I've already mentioned this before on our podcast, also other places. So let's look at Enphase and see what it's doing. Now, institutional buying and selling pressure is what I'm mostly looking at. So I'm going to go to this view. Now, when we look at Enphase, right, this graphic down here, the one down here, is showing the activity of institutions. This one is showing the activity of insiders. Now, here's something that I want to point out, and this is something that you might want to write down. Here's one of the bigger things that I mentioned today. When you see this shading in kind of blue gray color, when it's going down, that means that people are selling. Okay, so that means there's net selling going on. So when you see these spikes downwards in this gray area up here for insider activity, it means that they're selling. And when it's going up, it means that they're buying. Okay, so it has to be above zero to actually be buying, by the way. So it's all selling, but the selling amounts are getting smaller. So I shouldn't have said they're buying. They're not. They're selling more as it goes down, and they're basically selling less as it goes up, essentially. Anyway, so and I guess technically there could be some buying in there too. But let's just the point is, if you look at where the big spikes are, they're usually where the price of the stock is up. And what that basically means is that insiders have a tendency to sell, actual corporate insiders. This company is 3.1% insider owned, so it's not that big. That's a very small amount of insider ownership. So the insiders, they don't have that much influence on the value of the stock. This is an important thing too. Sometimes people overestimate the clairvoyance or the knowledge of insiders. All I can tell you is this: whenever institutions own a large proportion of a stock, trust me, they know everything that's going on in that company because they're on the board, they see all the information, they are privy to it. So therefore, they're going to know the same things that the CEO basically knows, right? So if we see the CEO selling and everyone's like, oh crap, the CEO's selling, I got to sell too. If the institutions are buying, trust me, they got 68.49% ownership. They're the people you should be watching, not the insiders. But it is telltale that the insiders are typically selling when the price is at a peak or near a peak. And what that basically means is they try to sell when the price is high, which makes sense because if you're going to liquidate shares to finance your lifestyle, which is typically why they're selling, then you don't want to sell when the price is low. You want to sell when it's high. Now, could you use this as an indication of when a transitional move might occur in the stock? Possibly. I would say it's worth considering, but I can't tell you that it's always going to work either, because you would need a lot of action from insiders for that to be used. In my opinion, is usually it's only on stocks like this one that are not extraordinarily big that something like this might be useful. If you try this on Apple, good luck. It's not really going to do you any good. But what's down here will. So as we notice, when the stock is coming down, that's what this blue line in the background is. As the stock is declining here from November 19th down to February, as it's declining, notice that you have some buying going on, but then suddenly there's a big spike in buying here, and the stock is really towards the bottom of its range. So you had some buying coming in over here. It dried up for a bit, then it suddenly increased sharply, and now the trend starts to go the other direction. What I'm getting at is this. The reason why this trend changed direction is because you had a massive amount of buying by institutions. They own a large percentage of the stock, so that means that since they own almost 70% of the stock, if they're buying, it's going to move the stock. We have an increase of 3% in institutional holdings of this company. We have 123 more buyers, 102 fewer sellers, and 5 more top 10s for this stock. It's in demand. So the way I found this is I actually did a screening for stocks that had a certain profile in terms of changes in their holdings, in their ownership. Now, what I was looking for, the way I found it was like this, and this is where I'm going to show you in the next part. Also, let me go over one other stock real quick, just another example, NVTS of the same pattern. This one's a lot easier to recognize, NVTS. So you see the blue line in the background. I reached a peak here at November 15, 2021. The stock is clearly declining, but notice that the institutional buying activity is increasing as the stock is coming down. Okay, so as the stock is going down, more buying is coming in. So we have an increase of 5.72% of ownership. We have 30 more buyers, 23 fewer sellers, and 1 more top 10. This stock is owned 15.39% by insiders. That's a big number, and it's actually comparable to the amount owned by institutions. So this one, I would say the activity of insiders does make a difference. Now, for whatever reason, in May, the director bought a lot of shares in the company, but as you can see, the stock price has not come up. It's still down. All right, so if we look at it on a chart, this stock is still trading in the lower end, but for whatever reason, institutional buyers came in for the stock at these lows. So this is a company that hasn't gone up in price. It's not going anywhere at the moment. It's still sitting there, but we can see the money flow. There's buyers coming in for some reason recently. So what I do with stocks like this on the screener is I look for them. And if I see that a stock is on a decline, but I see institutional buying coming in, just like we did for Enphase, right, over here, when in February of 2022 it was at its lows, suddenly buying pressure really kicked in. It was already coming in before, but it really kicked in after. And from that point, we see a rise. So again, this is just proof, evidence that when larger scale money commits itself to buying a stock, that will create the trend. And it's created because they're actually buying in such a way that it actually turns the trend in the opposite direction. Just like if the trend is up and they start to really sell, it turns it in the negative direction. So knowing what institutions are doing is that important, because how else are you going to know when the stock is going to get pushed up? So to find it, I'm going to go to the screener, and I'm going to use a different criteria, not up, down. Okay, I'm going to use something different. So actually, let me go back to here for a second. I'll go to new. Okay, and in the screener, and this is the next section, by the way. So we already went over institutional buying pressure. Now we're going to go over how to find stocks with high demand early enough to optimize for profits. Okay, how to find high demand stocks early. Okay, we're going to rocket through this. We're almost done with the webinar here. So how do I find it? Well, I want to use inner circle scores. That's what I'm going to look at. So I'm going to go here to insider score. I'm not going to choose any other criteria for right now because I just want to look at this and show you how it works. So all I did was select one. I went to the screener again, go to new, insider score. I hit apply criteria. Now it has a listing. Now this is telling me that the insider score, the lowest of all stocks out there, is -69. The highest is 40. And give me 1 second, actually. Let me do that one more time. Just want to see something. Okay, yeah, so I was right. 1 second. Some of these don't have insider scores, apparently. All right, so we have 1,795 stocks actually have an insider score, which means that ETFs don't have, well, they do, but that means that a lot of the stuff that we have to look at doesn't. So we have basically 1,800 stocks to look at. Okay, let's look at them. I'm going to put 20, oops. I'm going to put 20 as the number. And now I've got 6 stocks. Now, why did I choose 20? That's arbitrary. I could choose 10 as well. That'll give me more stocks. But what I'm doing is I'm choosing a strong insider score. Okay, so 10, 40 is the highest that exists of all the stocks out there. And we have some that are negative, meaning that people are selling. So I've got 17 stocks that have a score of 10 or higher. I'm going to run the search, and here they are. Okay. Some of these I recognize. Some of these stocks I know. BRT Apartments Corp. I recognize this one. It's all green. Let's take a look at this one really quick. So it has all green score. Average volume is very low, only 70.5 thousand shares a day. So this is not an actively traded stock. It's a real estate. It's a REIT. 9 employees. Very small. Very, very small. Looking on the chart, it has been doing fairly well, mostly going up. Okay. I look over here, this is where that score is coming from. So insiders are buying. And in this case, which is different than a lot of the stock we were looking at before, most of the buying seems to be coming in when the stock is on the lows. So some selling came in on the lows too, but they had some big buying when the blue line, which represents the stock price, was down. And once again, now the stock price has been down. Lots of insider buying is coming in. And then we look over here, the institutions have just been apparently buying across the board. There doesn't seem to be any particular pattern for it. They just seem to keep buying and buying and buying. So now institutional ownership is at 31.06%, while insider ownership is at 19.58%. We have an increase of 0.97% for institutional buying, 11 more buyers, 9 fewer sellers. So this is, again, not a really popularly watched stock, but if I'm doing the scan, I could have found it and possibly got in at a good time, right? Let's look at some of the other results. Okay, so let's choose one that's not going up, this one. I know the stock's going down. It has a decent amount of volume, 781,000 shares a day. Here's the overall trend. As I said, this is not a stock that's going up, it's down. But if I look at this activity here, notice there's a huge spike in insider buying. Okay, not necessarily saying that you do have a big sell too, 792,000 shares, but there was so much buying before it that I guess it's equaling out. But we have big buying here, and it's buying on the lows. But this is what I see that really gets my attention, this really clear pattern of increasing buying from institutions. They're at 37.68%. Insider activity is very small because this doesn't have a lot of insider ownership. It's only 0.26%, right? So if I look down here, this is actually not looking so bad. I've got a very good amount of buying activity coming in. on the stock. Consistent increases in institutional ownership. I see a 5.06% increase, 37.68% institutional owned, 47 more buyers, 15 fewer sellers, one more top 10. So this looks like something that's being accumulated on the lows. So therefore, if I watch the stock for a while, this could actually become an opportunity. So I'm going to turn on my chart, and basically this one I want to see if it can get into a trend. So that brings me to my next part, which is techniques that we can use to that we can implement to take advantage of these opportunities. Okay, so one thing is that I want to basically wait for this stock to actually start to trend up. I don't want to get into it right away. So right now it's on a trend down. What I'm looking for is for this to find some support here, turn around, and start to trend up. Once it starts to trend up, I'm going to look for a pullback in the trend, and then once it starts to resume in the trend direction, I keep going. So an example of that would be basically what happened here. You had a transition up, an uptrend begins, you have a pullback, it starts to go up. Now this one we could do, that's valid because we have a clearly uptrending line, which is why this long-term line is blue. The short-term line is above, so that all matches up correctly. Sorry, give me 1 second. Oh, why is this not showing? I assume you guys are seeing my screen, but anyway, I think there's a delay in the feed here, but okay, I'm not sure if you guys are seeing my screen or not. I guess you are, okay. I'll just keep going. I think my, oh, I see what happened. I accidentally clicked backwards. I'm watching my own stream live. Just want to make sure it's working, sorry. So we're finding support down here, but I was going back over here. So this is a valid entry. The short-term line is above the long-term. We have blue, so this is going up. So again, it's up first, it comes down, and it starts to go back up. That's where you want to get in. That's your timing. It did it again here, came down, starts to go back up again. That's again your timing. Like you want to get in where you see these transitional moves back up. Now, this never lasted for very long. The stock is still drifting lower. So unfortunately, if we had gotten into this, we wouldn't see any gains that we could hold on to for very long. But eventually, if we start to see this trend again, we may be able to get a second opportunity. So this is a stock you want to watch. You don't necessarily have to do anything right now. You just have to keep an eye on it. And once it starts to do the type of trend we're looking for, if it does, then we go ahead and get in at the right timing. So the primary thing that you want to do is wait until a company is showing up on the radar. You've got some news that says, hey, this is why the stock should be going up or down. Then when we time our entries, we're looking for exact entry and exit points based on the trends that we're seeing on the screen. So once I see the right setup, the pullback and resumption of the trend, that's where I want to get into my position. Okay, I want to see the stock transition into an uptrend, pull back, and then start to go up. Pull back and start to go up. Those are my entry points, and both of these would have worked out fairly well. This one would take us from about $41 a share up to a peak of about 50. This one took us from about, assuming we got in around here, somewhere around right here, about $38 a share, up to a peak of about 45 something. So these are pretty good moves percentage wise in very short amounts of time. So doesn't mean we have to hold long term, but this gives us a way to get into stocks that at least have some buying pressure. And then lastly, I want to summarize one last thing. So we want to look at the screener again. I'm going to go to new, and this time I'm going to look at volume. This one right here, up-down volume ratio. Now notice I have a huge listing of stocks, so let me edit this to limit the price range for these stocks. So I'm only going to look at stocks that are between $3, oops, did it again, sorry. I'm only going to look at stocks that are between $3 and let's just say $1,000. Okay. Oh, sorry, I did the wrong thing. I meant to do that here. 3.00 to 1,000. I want to do that down here. Okay, and I want the up-down volume to be different. Let me add one more criteria. Let me add average volume. I just want to make sure I'm not looking at stocks that never trade. So 10-day average volume, I want to be somewhere between 500,000 or more. Sorry, I keep clicking my, I accidentally keep clicking my laptop here instead of my actual keyboard. So I want the 10-day volume to be no less than, let's say, 400,000 shares per day. And now I'm going to try to cut this down to a smaller number. Let's say 10. Okay, that's still high. Let's say 100. I'm trying to get down to only a small amount of stocks. Okay, there we go. Now, I'm just doing this arbitrarily, guys. This is not, just to be clear, I don't, you kind of have to feel your way through the up-down volume ratio because it can mean a lot of things. But right now I've got 23 stocks that have an average daily volume of at least 400,000 shares, a price between $3 and 1,000, and an up-down volume ratio somewhere between 500 to 1,000. What I'm trying to find is something where a lot of buying pressure is going on. Okay, so when I run the search, here they are. And I'm going to look first at the stocks that have the most green. So here's Serious Point. I don't know anything about them, but let's look at it. So Serious Point, whoa, that's a nice looking trend. Let's look at it on the long term. Okay, long term has been mostly coming down, but it looks like we just transitioned into an uptrend. This is good. This is exactly the type of situation I like to find, where a stock has been mostly down, but now starts to go back up. So that's what we're seeing on the right. The stock is starting to recover into a trend. We actually had two pullback opportunities on this one, okay, that I can see. We had the first rally up there, where the stock trend went up, it pulls back, and then it starts to recover right there. And then we got our second round where it came down, it started to come up right there. So we had an entry point potential there on the 28th, and a second one there on the 13th. Now, if we were to manage our risk, we want to make sure that the stock stays within the blue channel. So if it were to go down to the bottom of that blue channel, that's where we would be looking to exit, because that would imply that the stock is probably going to move significantly farther in a negative direction. However, Sometimes if we can get a buy right when the stock comes down to here and starts to go back up, that's a great buy, because usually that means that that's as far as the market wants to go. But in this case, since it was flat for so long in the same area, I would interpret any move down to that bottom of that blue area as evidence, clear evidence that the stock is breaking down. So this doesn't look bad at all on 2 counts. Okay, so now that we've done that, all we have to do next is look at the other details about the company. Now notice all I did, let's just go through the steps. I chose a stock that had an up-down volume of between 500 to 1,000. Now that I chose that number arbitrarily, just to be clear. The top number I deliberately made 1,000 because I'm trying to filter out stocks that have these absurd ratios. Usually those are stocks that barely trade at all. Like no one trades, and all of a sudden one day someone buys 1,000 shares and it jacks the buy-sell ratio up. I'm looking for stocks that are in a certain price range. No penny stocks, no companies at 50 cents or anything like that. And I'm looking for an average volume that's significant enough that this means that the stock is active. It's not like a dead end type of stock. So when I went to the screener after that, these were the results I got. And I'm just looking at the score. I'm looking at the colors I see here. I'm looking for the ones that have a lot of green. And I saw that this one had a lot of green at the front and it had yellow at the bottom, which is fine. This one also looks good, right? Generally, I actually prefer there be a lot more green at the bottom. This one might be really coming up right this second because it has a negative overall trend still, but there's all greens at the bottom, right? So if I look at this guy, it is coming down. Doesn't look like it's in a transitional move up yet, but that buying activity, this is what we're actually searching, this money flow. You can see there's a huge amount of buying that came in on the 21st. So I would suggest that that probably means institutions are starting to buy. We don't see it yet over here because we have to wait until the institutions file their reports with the SEC to be able to know that they're buying. But we do see an increase in institutional buying. It's at 51.83% overall. 45 more buyers, 14 fewer sellers, and 4 more top 10. So this is a stock that looks like it's in demand. So therefore, what we will probably see when the next reports come out is that some big institutional buying came in on the 21st, and maybe also some days before that. We don't know who did it, but someone came in and started buying shares at a heavy volume on the 21st of October. So that was Friday, of course. So that means that probably we're going to find out that maybe BlackRock or maybe Vanguard or somebody started to buy in. We don't know who yet, but we can see their activity. So now we have something that could be a buy opportunity right now. If we were to buy right now, we're basically jumping ahead before the trend is actually there. And in this situation, I would say that's a reasonable risk, because if we're wrong, we're risking about $4 a share. But fundamentally, the stock shouldn't go down to less than 41.81. That's the lowest projected target. We're currently at 48.37. The median upside target is $75. So if I were to look at this right now, in fact, on Monday, I am going to put this one out as an alert, because everything I can see about it looks pretty good, and it looks like institutions are coming in right now. So therefore, I can put out an alert that we were going to try to average in at the lows. So maybe we get some at this price. We try to get the second half at the projected lower price target for the analyst. It's around $42 a share. We can set a stop loss and we'll wait and see what happens. So just like that, I'm able to find something. I haven't looked at the reasons why the stock is moving yet, so that's something I'll do the research on first. I just want to make sure I know what the picture is, just following a line. But the technical signal is there. I just need to confirm when I read up on the company that it actually makes sense to buy it, because maybe there's something that the technicals are not seeing. This stock, I don't know too much about it, but it looks like it gapped up. I'm guessing this was a buyout based on the way that the chart's trading. So this one probably was bought out by another company, which is why it suddenly leaped there. I don't see any earnings bubbles. The last earnings was over here, so I guess that's what happened for this company. All right. So folks, let's just summarize everything we've covered here so far. Okay, we've just explored some techniques to exploiting the stocks that we identify. We know why they're moving up, right? So we've got what causes a trend. We now know how to find high demand stocks early by using our screeners to look for institutional high, stocks with a high insider score, also stocks that show strong buying activity, which is the second thing we looked at, the up-down volume scan. And then exploiting it just came down to timing. We're looking at the charts to see when the stock is starting to trend, and we're looking at key levels of support and resistance. Now, in our next session, which will be 2 weeks from now, we're going to look at, we're going to specifically go into detail about supply and demand, which will lead us into support and resistance, so we can start to analyze those topics in more detail and give you a better understanding of how to use that information to make trading decisions. All right, so in conclusion, guys, thank you for joining me again. Obviously, as always, we have some technical hiccups along the way, but as time goes by, I'll get better and better at doing these live streams. So hopefully everything has worked smoothly on your end. I am recording this, so as I mentioned, I will be saving this to archive onto our channel. The last lesson was also archived. I just updated the software to a better quality recorder, so that way I think the feed will look better, and then we'll go from there. All right, folks, now in the chat, if you have any questions, feel free to type them in. I'll type in any questions. And by the way, the person when I typed hi, folks, that was me on my personal email account. I logged into the feed myself, so that's just where you saw that coming from. All right, guys, any questions? All right, guys. Listen, everyone, have a great weekend, and I'll see you guys in 2 weeks. And I'll send out an email just like I did before with the link to the live feed once it's up and running, and then we'll go from there, okay? Take care, folks.